Did you know that for every $1,000 you deposit in the bank, they can create another $900 out of thin air? Are you really in control of your money? Let's uncover secrets that could change your financial future. What if I told you that the place where you're keeping your hard-earned money is actually making you poorer? We're talking about something we all care about, money. We all use banks. We put our money there thinking it's safe and maybe it'll even grow a bit. But that's not the whole story. The average interest rate on a savings account is less than 0.5%. That's right, less than 0.5%. And let's not forget about inflation, which is usually around 2.5%. So if you do the math, you'll see that your money is actually losing value over time when it's sitting in a bank. In this video, we're going to reveal some big secrets that banks would rather you not know. We'll talk about how they use your money to make more money for themselves, not for you. We'll also look at how inflation is like a silent thief that chips away at your savings and some smart moves that rich people make to turn the tables and make the system work for them. The illusion of safe banking. So, you've worked hard for your money and you want to keep it safe. The first place most of us think of is a bank. But here's the catch. The interest rates they offer on savings accounts are laughably low. The highest interest you can earn on a standard savings account with a minimum deposit of $2,500 is 5.84%. The average interest rate is a mere 0.23%, less than 0.25%. Now, you might think, well, at least it's something. But let's add another layer to this: inflation. Inflation is the rate at which the general level of prices for goods and services rises, and it's usually around 2.5%. So if you're earning less than 0.5% on your savings, but inflation is at 2.5%, you're actually losing money. Your savings are not growing, they're shrinking in terms of what you can actually buy with them. So let's look at how it's affecting asset prices. Have you noticed how the cost of homes and stocks has been going up? That's not a coincidence. It's a direct result of inflation. When the value of money goes down, it takes more of it to buy the same things. So, while it might look like your assets are growing, they're just keeping pace with inflation. If your money is sitting in a bank, it's not working for you. It's working for the bank. They're using your deposits to make loans at much higher interest rates, and they're pocketing the difference. The money creation machine. You might think that when you deposit money into a bank, it just sits there waiting for you to use it. However, that's far from the truth. In reality, banks operate on a system called fractional reserve banking. This system allows banks to keep only a fraction of your deposits as reserves and lend out the rest. For example, if you deposit $1,000, the bank might keep $100 as a reserve and lend out $900 to other customers. This is how banks create money. On March 26, 2020, the Federal Reserve reduced reserve requirements for all depository institutions to zero. This means that banks are now paid a specific interest rate on their reserve balance to encourage holding reserves rather than being required to hold a certain percentage. Most of the money in today's world isn't physical cash, it's just numbers on a computer screen. This digital nature of money makes it incredibly easy for banks to create money. When a bank lends out money, it doesn't have to print new bills, it simply changes some numbers in its computer system. It means that the money you think is safely stored in your bank account is often being used by the bank to create more money, which they then lend out at higher interest rates. And while this system has its advantages, such as stimulating economic growth, it also has its risks. For instance, if everyone decided to withdraw their money at the same time, the bank wouldn't have enough reserves to cover it, leading to what is known as a bank run. Borrowing to build wealth. You might be surprised to learn that Mark Zuckerberg, the founder of Facebook and one of the richest people on the planet, took out a mortgage to finance his home. Why would a billionaire need to borrow money? The answer lies in the concept of free money, which is closely tied to interest rates. In 2012, Zuckerberg financed his $5.95 million Palo Alto home with a 30-year mortgage at an interest rate of just over 1.05%. With inflation rates hovering around 2.5% to 3%, borrowing at such a low rate is essentially like getting free money. So how does this work? When you borrow money at an interest rate that's lower than the rate of inflation, you're essentially getting that money for free. Suppose you borrow $1 million at an interest rate of 1.05%. Your annual interest payment would be $10,500. Now, let's say you invest that $1 million in a savings account that offers a 2.4% return, which was the average rate before the pandemic. Your earnings would be $24,000 a year. Subtract the $10,500 you owe in interest, and you're left with a profit of $13,500. And that's just a basic example. Imagine the possibilities if you're dealing with larger sums of money. The rich get richer. The adage, "The rich get richer," is a concept that extends into the banking world, particularly in the realm of interest rates. Contrary to popular belief, banks do not offer a one-size-fits-all rate to their customers. Wealthier individuals often receive more favorable interest rates, and this isn't due to favoritism. It's a strategic business decision. When we delve into the mechanics of banking, the reasoning becomes clear. Banks earn money through the difference, or spread, between the interest rates they charge borrowers and the rates they offer to savers. As interest rates climb, this spread typically widens, boosting the bank's profitability. Therefore, offering lower rates to wealthier individuals, who are perceived as lower-risk borrowers, becomes a worthwhile gamble. These individuals are less likely to default on loans, ensuring a stable return for the bank. Take, for example, two individuals, Alice and Bob. Alice has a substantial income, a high credit score, and a robust financial portfolio. Bob, on the other hand, has a moderate income and a less impressive credit history. A bank might offer Alice a mortgage rate of 3.5% while presenting Bob with a rate of 4.5%. The difference in these rates is not insignificant. Over the course of a 30-year mortgage, it could mean tens of thousands of dollars in additional interest payments for Bob. So, how can the average person benefit from the preferential rates offered to the wealthy? The key lies in enhancing your financial attractiveness. Improving your credit score is one of the most effective strategies. This can be achieved by paying bills on time, reducing debt levels, and correcting any inaccuracies on your credit report. Demonstrating a stable income by maintaining long-term employment or having a consistent track record as a successful entrepreneur can also sway banks in your favor. A strong financial history, including a portfolio of investments or savings, showcases your financial responsibility and capacity, making you a more appealing candidate for lower rates. Let's consider another example with credit cards. Credit card companies often reserve their lowest interest rates and best reward programs for clients with top-tier credit scores. These clients receive offers for platinum or black cards, which come with perks such as lower interest rates, extensive reward points, or travel benefits, which are not typically available to those with average credit scores. While it may seem like an uphill battle, working towards a better financial position can significantly reduce the cost of borrowing. It's a virtuous cycle. The more financially secure you become, the less you pay to borrow money, allowing you to further invest and save, thereby enhancing your wealth and creditworthiness. This journey towards financial improvement is not just about accessing lower interest rates. It's about building a foundation for a more secure financial future. The credit card trap. According to the most recent data from the Federal Reserve Bank of New York, Americans have accumulated over $1.031 trillion in credit card debt as of the second quarter of 2023. This marks the first time that credit card debt in the U.S. has exceeded the $1 trillion threshold. The debt level has risen by $175 billion since the fourth quarter of 2021, and it's $104 billion higher than the previous record set in the fourth quarter of 2019. Credit card debt isn't just a personal issue, it's a national concern. High interest rates are a major factor contributing to this debt. The Federal Reserve has increased the target interest rate 11 times since March 2022, which has had a direct impact on credit card issuers. Consequently, many have raised their annual percentage rates, APRs, making it more difficult for consumers to pay down their principal balances. Many people find themselves maintaining a lifestyle they can't actually afford. The national average card debt among those with unpaid balances was $7,279 as of December 2022. In Connecticut, the average debt is $9,408, while in Kentucky, it's the lowest. The risks of irresponsible credit card use are significant. With high interest rates and the temptation to spend, it's easy to get caught in a cycle of debt that's difficult to break. This is especially true for younger consumers. It shows that Generation Z had the largest year-over-year percentage increase in credit card debt of any age group, rising by just over 25% from 2021 to 2022. So, the next time you're about to swipe that credit card, pause and think. The choice is yours, but be aware, the consequences are serious. According to Forbes, good money management is key to creating wealth. It's not about how much money you make, but how you manage it that counts. If you want to be financially savvy, smash that like button, share this video, and don't forget to subscribe.